how can you get 200% on your dollars with Compound? How does liquidity mining work, and what is yield farming? Let's dive in, let's discuss a couple of those things, and at the end, I'll give you my opinion whether this actually makes sense or whether this does not. So stay tuned. Hey and welcome to today's video. My name is Julian. I discuss the beautiful world of investing, mostly cryptocurrencies, hence the hashtag cryptofit, fit for the world of blockchain, cryptocurrencies, decentralization, much more. And again, mostly we talk about Bitcoin, but we discuss altcoins, stocks, precious metals, real estate. Today, I wanna talk about a topic that's been all over the news, as you will see. And I've prepared, I think, 22 slides. You will definitely love this slideshow. And well, it will teach you how you can get 200% per year on your dollars. And key thing, you want to stay all the way, because at the end, I'll give you a couple of goodies and I will give you a bit of my personal opinion in how this works and what's happening. By the way, if you are not looking into getting a return on dollars, because this is on dollars, if you want to get a return on Bitcoin and Ethereum, we at Cake, so that's my company that I co-founded, we are for a limited time only pay 9% on Bitcoin per annum and 8% on Ethereum. I can put this in there and then you can see and check this out. So go to Cake, test it out, register for free, see the returns. We are completely transparent, trust, but verify disallows. So yeah, you're definitely gonna love it. So check it out and have fun. But now let's dive into today's video. And here is a screen share that I prepared that I wanna go through with you. And basically, I wanna discuss a couple of things. First of all, I need to start with some basics, because I assume a couple of people are gonna watch this video who have not heard about what this entire thing is actually about. What we are talking about here is something called DeFi, decentralized finance. And this is how all this here works, how you can get 200%. And this is not a scam. This is, now we can discuss how risky it is, and we're gonna do this, but this is not a scam. This is not a pyramid scheme. This is purely based on legit building blocks. The key thing, now this is the key thing, and that's why I want you to stay until the end. We need to talk about risks, and we need to talk about like volatility and stuff. But this is what a concept of DeFi and now with Compound kind of allows. So let's kind of do this. So DeFi, decentralized finance, basically takes traditional finance, that's a lot of bureaucracy, a little software. Fintech had less people, but more software. And now DeFi goes in a way where it replaces this traditional banking system, and it uses trust minimized software. And so it has very, very little people. And we have seen this build up, build on Ethereum. As a quick side note, for example, I'm involved where we're bringing DeFi to Bitcoin. If you want to check out DeFi chain, you can kind of look this up. That's where this graph is in there. But basically, a lot of this DeFi stuff has been happening on Ethereum. And we have seen many companies. The company that right now kind of makes all the hype, all the waves, is Compound. And basically what Compound does, it works like, again, a decentralized bank, decentralized finance. And it allows you to borrow and to lend. And that's the whole concept. Now, the idea why it's decentralized is because it works with smart contracts based on Ethereum. And if all these smart contracts work properly, and obviously that's the big if, then it should be fine and everything should be working. But obviously there are a lot of risks involved that we are gonna be discussing. Compound is not a no-namer. No. It actually has some really strong backers. You can simply see this by who has a lot of the governance tokens. Yeah, so Andreessen Horowitz, I mean, humongous, or very important kind of VC in the Valley, and then Polychain Capital. I mean, these are some really strong kind of backers. The team is strong. I mean, it's well known. Compound has been around for quite some time. So this all looks super solid. And so basically, instead of you going into a bank, well, you go to their website and you do a deposit. And well, you can do this yourself. You go to app.compound.finance. You can use either Ledger or MetaMask. And basically, you can deposit all those different things. And when you go there, you can see supplying. So you basically lending it out, or you can borrow. And obviously, what you can see is there's obviously a spread in there, which is basically how Compound makes money. So that's the spread. It's just like a bank, right? And so you have BAT, you have DAI, you have Ether, you have Augur, you have USDC, Tether, Rep BTC, 0x. So you have a lot of these different coins. But so how do you get to receiving 200% per year? So how would this work? Well, there are different ways in doing this, but let's walk one way through and kind of understand this. So you go there and you deposit, for example, Tether. And you can deposit this, or you can deposit many, many other things. But let's just say you deposit Tether. And this gives you what's called a collateral. And you can use this to borrow something else. And you have different kinds of ways there. So where you can kind of use it as collateral, but then use for the collateral with a different certain amount for something else. And what you can do here, you can go to InstaDepp and you can calculate what's gonna maximize something called compound mining. And I'm gonna actually go there what this actually means. So what it actually allows you to do is you deposit something and then you borrow against this. You borrow against it and then you lend more. And so basically you're just creating a cycle. And it is a cycle of, well, you put $1,000 in, for example, you loan $500 out, you put the $500 in, you loan $250 out, you put the $250 in, you loan $125 out, you put $150, and so on and so on and so on. And you just basically kind of get rich quick by, well, kind of compounding, that's why kind of the name. You kind of pool those funds together and you kind of stack them all together. And I'm gonna show you in a second how, like, where does it actually come from that now you're receiving 200% in return. And I mean, obviously there's people who are maximizing this and it goes crazy on the internet, like really crazy. So like, I really am gonna kind of base this out because you might be sitting here and thinking, so, but where is the 200% here coming from? Now, obviously on the one hand, because you're really leveraging the dollars you're putting in, because you're really kind of stretching. So you're using leverage, right? That's the first thing, you're using leverage. And well, if you think you're the only one, no. There's actually really a lot of people doing this. So here, this is Compound. And now since this governance token, since this mining started, and this is what all the hype is, this shot up from like 100 million assets under management to like close to 600 million assets under management. So I mean, overnight, this thing went haywire. Now, just as a comparison, right? So this is Maker, which has so far been the largest kind of DeFi protocol on Ethereum. That's smaller now, right? So DeFi is basically, Compound is basically overtaking Maker, which is insane if you think about it. If you look at the amount of ETH that's locked in DeFi, look how this thing went parabolic as soon as this Compound liquidity mining kind of started. And this is where all this thing is happening. So if you're wondering, so how in this entire process, like by me putting in $1,000, loaning out, like using it as collateral, taking 500 out, putting the $500 in, using it as collateral, and kind of stacking, where does my insane return come out of? Well, this is where this liquidity mining is coming from. Compound started the Comp governance token. And that token is created, I mean, obviously they started with a large bunch up front, but now you can mine the rest. And the rest is mined by a process called liquidity mining. Whenever you make a transaction on there, whenever you move, the borrower and the lender receives Compound tokens. And these tokens are being used for governance, so for voting decisions. And you can kind of see the process here, right? So you have this reservoir, and then, well, Compound is basically used in proportion to all these things being used here. And it goes 50-50 to the suppliers and to the borrowers. And that's basically all the hype. So if you're hearing this concept of liquidity mining, this is where this is coming from. People using kind of this entire bank, basically it's a bank, to borrow and lend. And so the concept here, now you need to pay attention to this. The concept here is not so much about any kind of normal interest. It's only about maximizing for this governance token. So all you're trying to do is whatever movement you're making, maximize for receiving the most amount of compound, because if you can stack this amount here on the left in a way that this thing really shows you the money, basically pays you all this compound, you are maximizing your return to 200% per year, because this is what compound basically is worth. And so just to kind of show you a bit on what's happening here and how the compound mining has been working so far. So you can see here, this is a lot of DAI. This is USDC. So this has been over the past couple of days, basically how the entire rate has been working and how the entire thing has been running. So pretty crazy. Now here is where the hype kind of started. So far, compound wasn't really traded on any kind of large exchange because there was just no interest. And it was mostly those decentralized exchanges, right? Like Uniswap and so on. But, and obviously that's where the hype is coming from, Coinbase announced that it's going to be listing Compound today, June 23rd. Now, when this thing got announced, this thing went parabolic. And this was announced like a couple days ago. And so after that, it went parabolic. And that is where suddenly all this liquidity mining actually became meaningful. Because now suddenly it was not about the returns you are getting out of the token itself, the actual lending return, but it was kind of, you got this new token out, and it was all about getting this new token out. And so if you think about it, the incentive now became, how can I stack those things in the most efficient way, not to optimize for returns there, but to optimize for this new token that hopefully had some value or is going to have some value. And if you think this is crazy, you have no freaking clue. Like, it's uber crazy. Here, there's people now on Twitter and everywhere pushing this thing called yield farming. And so basically what yield farming is here, I farm yield in DeFi. What these people are doing, they are purely algoring or playing, stacking, that they maximize for these tokens that kind of pop out of this. So in this case, they optimize for compound, right? So they can like mine compound the most efficient way. Now, obviously, there are some issues in this. First issue, these smart contracts have had massive problems over and over and over and over and over again. Not the compound specific ones, but if you just go back, I mean, the DAO, Parity, DYDX, and so on. Like, we have had so many smart contract problems on Ethereum. And I mean, one of the reasons why I personally am really going for non-Turing complete DeFi is because it doesn't have all these problems. And I believe in DeFi, but it might have problems going forward. And I just can foresee already how this thing is just going to blow up massively. One of the major problems, smart contracts. The second one is this uber leveraged position from so many people. And I mean, I see this on Twitter and Reddit over and over again, where people put in $1,000, they stretch this basically to like $10,000. Now, if this thing just moves a slightly bit, their leverage position completely evaporates and their entire money is gone. So, and this happens over and over again. You can just go on Reddit, on Twitter, it's just insane. But now there's the third part, and the third part is, while you're borrowing on this left side, you obviously have to pay interest there. Now the question is, this only works out if the compound and the entire thing just always is more than the loan collateral. And so this thing has to keep going up. If it doesn't, I mean, and you think this is a small problem? Forbes just wrote about it yesterday and talks about, Forbes talks about how these crypto investors are going for 100% plus annualized yields. I mean, this is exactly what crypto, in my opinion, should not have. It shouldn't have these headlines. Because this is exactly where the average person out there, the average investor, institutional funds look at this and they're like, right, what do these idiot kids do again? Like how are they, like what kind of bubble, what kind of scam are they building again? The thing is, it's actually not it's not a scam, it's not a pyramid scheme, it's completely legit. Compound, what they're doing, all the building blocks are super legit. And the problem is it has nothing to do with Compound. It is how people are misusing the system by stretching their risks in insane ways. And I mean, like just look at valuations here. This is Compound. The price right now, and obviously I'm not sure if you can use like a price to earning of total cap, but we're talking about hundreds of X's here. So until any of those prices make sense, because that's what you're basically going for, Compound has to have this price, otherwise it's just gonna evaporate. I mean, the entire thing is just not worth it. That's a humongous stretch. So anyone using this, not for its original intent, which is just like, okay, here, there's $1,000, let me take something else out, I'm not leveraging it, that's fine. This entire stacking and gambling on Compound, because you're gambling on, and that's actually where it gets crazy, you are gambling on the price of Compound having to increase, otherwise this entire bubble is gonna implode. And I posted this on Twitter, and guess what? There were so many people who are in this Compound scheme right now who obviously just don't want exactly this narrative. The narrative is, remember 2008? 2008 was people buying houses they couldn't afford, using it as collateral to buy more houses they couldn't afford, to buy more houses they couldn't afford, with the hope that these house prices would continue going up, so that the going up house prices would automatically offset their loans plus make them return. Now obviously this went well for a couple of years, and years in real estate are days in crypto. It's now 2020, and I'm not kidding. We have the exact same situation where people need to have increased prices for the scheme to work out. One time that this thing drops a little bit, all these collaterals get evaporated, get force sold. Now guess what's happening? They trigger more triggers, and it's an entire avalanche of stuff just collapsing. And all this is, and this is now where, to me, it really kind of comes down what my personal opinion is. Compound is super solid. I'm still skeptical of Turing complete smart contract, hence on why I'm on DeFi chain, non-Turing complete, but hey, I mean, still, there's a strong use case there, all fine. But the way Compound is used right now, this is just a house of cards waiting to collapse. And like, look, there's in bubbles, there will always be the majority of people only losing money. Just like, I mean, that's a quote from Isaac Newton, who lost like so much money during the South Sea like stock bubble. And he said, I can predict the planets, but I can't predict the price of a stock. And he lost a lot of money falling for the same kind of FOMO hype, like fear of missing out, all the excitement. And so just don't fall for this. And like summarizing, I think Vitalik in these tweets 2 days ago, he really kind of described it well. DeFi should not be about optimizing yield, which is exactly what most people are doing right now, which makes zero sense. Rather, we should be solidifying and improving a few important core building blocks. Synthetic tokens for fiat, totally agree. Few other major assets, stablecoins, and oracles. Honestly, I think we emphasize flashy DeFi things that give you fancy high interest rates way too much. Interest rates significantly higher than what you can get in traditional finance, and now pay attention, are inherently either temporary or come with unstated risks. And in this case, I actually believe it's both. It's purely temporary because of arbitrage that people don't understand, don't see, and because of major risks. So that is my personal opinion on this. Now, you look at Twitter and Reddit and you ask these comp farmers, because at the end that's what they are, then obviously their reaction, their opinion is a completely different one. So let me play you that video so that you see how these people are.
Было намного лучше, но на этот раз как-то не удалось. Во-первых, народу мама, музыка не очень.
А что за направление?
А?
Что за направление?
Направление? Какое направление?
Что за направление музыки играет там?
Yep, people don't care as long as the party keeps going. The question is just, how long is the party gonna keep going? If you want to trade comp, if you believe this thing is going up or down, you can trade this in FTX. It has a future there, and this might be an interesting way for you to take a more appropriate kind of action on all of this. So with this, I hope this kind of explains everything. All the links are down below under the video if you want to check out Compound. Again, Compound is super solid. All the building blocks are solid. Maybe there's some bugs in the smart contracts, this can happen, but all this is not a criticism against Compound. It is, once again, just like what Vitalik is saying, it's criticism against the greed and stupidity of inexperienced investors that think there is a way to generate risk-free returns that are massive, and it's not. In crypto, I think, in crypto, anything up to 10%, hey, we have seen this for a long time, that looks solid, but once we're talking about 100%, be careful. That's all I'm saying here. With this, I hope you get value out of this and explain to you what liquidity mining is, what yield farming is, how Compound works. If you get value out of this, then subscribe to the channel so you don't miss any further videos. Click the like button or on the podcast. Give me a review on Facebook or on Twitter. Click a heart or like. And yeah, I'll see you at one of our next videos. One last thing, again, if you want to get returns, not on your dollars, but on Bitcoin and Ethereum, check out the most transparent platform out there with some of the most interesting returns. And these are solid returns. 9% on Bitcoin, 8% on Ethereum, Cake DeFi, I'll link it up below as well. You can also get DFI there, which is the token for the DeFi chain. And yeah, I hope you're gonna be one of our users. With this, have a good one. Thank you all. Bye-bye, Julian.